Okay, let's unpack this. For the better part of a decade, the story in personal finance has been this huge battle, right?
Mhm.
On one side, you have the traditional human financial advisor. And on the other, you've got these sleek, low-cost, 247 DIY investment apps.
Right. The apps that were supposed to democratize finance for everyone.
Exactly. But the source material we're digging into today, which focuses on investors right there in the Stuart, Florida area, it suggests something, well, surprising, that the war is basically over, and neither side really lost.
It's maybe the biggest evolution in investor behavior we've seen in a long, long time. The thinking was always that technology would just make professional advice obsolete.
Of course.
But the data, it shows the exact opposite. Technology is actually what's driving people to seek out higher level, strategic support.
Which is why our mission here is to move past that simple app versus advisor debate. We're looking at what the source is calling the hybrid investment revolution, how modern investors are using both the speed of tech and the personalized strategy of a human.
And the numbers completely back this up. I mean, the one single insight that frames this whole conversation is this. Investors who use digital tools are almost twice as likely to also work with a financial advisor.
Twice as likely.
Yeah, compared to people who don't use digital tools at all.
That's the central nugget right there. We're talking 62% of digital users also have an advisor versus just 34% of non-digital users. So that huge gap, it just begs the question, why? Why are they dual tracking? If the apps are so great, why pay for a human?
Because the app handles the what, but the professional handles the what if. The app is great at execution tracking, trading, low-cost entry. When life is simple, it's perfect.
The life doesn't stay simple.
Never. The minute it gets complex, you buy a house, you inherit some assets, the app just hits a strategic wall. I mean, think about it. Can your app help you figure out the rules around spousal pension benefits?
No.
Or, and this is a big one, can it prepare you for the estate tax exemption levels that are set to drastically drop in 2026?
Okay, hold on. Let's quickly define that for our listener. When you say estate tax changes, what does that actually mean for someone?
It means a huge potential tax bill. Right now, the amount you can pass on tax-free is very high. But in January 2026, the law is set to change, and that exemption gets cut roughly in half.
Wow.
For families with significant assets, that could suddenly mean millions of dollars are now subject to federal estate tax. An app can't plan for that. It can't suggest strategies like trusts or gifting. That takes strategic human planning.
So this isn't about ditching tech at all.
Not at all. It's about recognizing where that strategic foresight becomes absolutely critical.
And here's where it gets really compelling. You probably assume, that the older generations, maybe the ones less comfortable with tech, are the ones going to advisors.
That would be the logical assumption.
But the source shows a total paradox. It's the generations that grew up with these apps, Gen Y and Gen Z, who are leading the charge back to professional guidance.
It's true, and in a way, they're the savviest investors because they see the limits of their tools much faster. The data says about 27% of general DIY investors will probably hire an advisor in the next year.
Okay.
But for Gen Y and Gen Z specifically, that number jumps to 37%.
So why are they, the digital natives, the ones saying, okay, I need an adult in the room?
It's all about a realization that the knowledge you need scales with your assets and your complexity. Look, when you're 22 and your only goal is putting $1,000 into an S&P index fund, the app is perfect. It's a simple transaction.
Yeah.
But fast forward 10 years, now you're 32, you've got a mortgage, maybe a rental property, a big 401k to rebalance, kids' education to think about, student loans.
That's a completely different ballgame. That's not a transaction anymore. That's a whole interlocking system.
Precisely. And to bring it back to our listener in Stuart, that complexity gets magnified when you relocate. Stuart attracts a lot of young professionals moving from, say, New York or Massachusetts.
High-tech states.
Exactly. They arrive in Florida, a state with amazing tax benefits, but their financial life is still set up for the rules of where they came from.
So their app portfolio is basically optimized for a tax environment they're not even in anymore.
You got it. The brokerage app doesn't go, oh, wait, you just moved to a zero income tax state? We should immediately look at Roth conversions differently.
Right. It doesn't have that context.
It takes a human to spot that critical moment and say, okay, let's restructure everything to maximize the advantages of being in Florida.
That makes perfect sense.
Yeah.
Okay, so let's give the tech its due. What does the app scorecard look like? Where have they made a real positive impact?
Oh, their biggest win, without a doubt, is that they democratized investing. They tore down the
The
barriers.
intimidation factor, the high fees.
All of it. And the data shows they've genuinely improved investor behavior in one key area: tax efficiency.
Oh, interesting. How so?
Just being able to see our portfolio so easily, track gains and losses, it's made people more aware. The source found that 66% of app users are actively using tax-efficient strategies.
66%. And for non-app users?
It's only 32%, so it's more than double. That is a massive, measurable victory for the retail investor.
Okay, so the apps are great educators, great for efficiency. But you mentioned that pivot point. The moment complexity hits, where do they fail?
They fail the minute your finances get too individual, too specific, or cross state lines. The source points out that 41% of DIY investors stick with apps because their finances are, and I'm quoting here, simple enough.
Simple enough.
The Second Life throws you a curveball, that simplicity just vanishes.
So what are those curveballs? What are the top scenarios that make an investor in Stuart realize their app can't cut it anymore?
Well, the source outlines 5 big ones. First is inheriting property, especially from a relative who lived in another state.
Right.
The app can't advise you on the step-up in basis rules or the local property tax laws, or if selling now versus holding is better for your Florida tax situation.
That's a huge coordination problem. What about money you get from work?
That's number 2. Employer stock options with complicated vesting schedules.
Vesting.
The app shows you the stock price, sure, but it can't tell you the best time to exercise those options to minimize your tax hit, especially the alternative minimum tax. That's way beyond a simple interface.
And that's critical because so much compensation now, especially for those professionals relocating to places like Stuart, is tied up in stock.
Absolutely. The third one is funding a child's education, coordinating 529 plans, tax credits, all while not wrecking your own retirement.
And what's number 4?
Planning for an early retirement. It's a huge goal for many, but the app can calculate a withdrawal rate, sure. But a human advisor has to map out the incredibly complex strategy for bridging your healthcare coverage until Medicare kicks in. That's the single biggest risk.
That's a massive regulatory knowledge gap, not just a market tracking problem.
Exactly. And the 5th is for small business owners coordinating your personal and your business investment strategies.
When everything's tangled together.
When it's all one big pot, the app becomes a liability. You need someone looking at asset protection, succession planning, tax efficiency, all of it, holistically.
That list really shows the app is a brilliant calculator, but you need an architect for the design. Which brings us to the next level of tech, AI.
The elephant in the room.
Right. If the simple apps fall short, surely AI is coming to replace the advisor completely. That's the fear, isn't it?
That's the narrative. But the data shows this massive trust gulf. Over half of investors, 53%, are using generative AI every month for financial research.
Okay, so they're asking it questions.
Yeah, how does a Roth IRA work? Or what are the historical returns of this sector? They trust the information. But when it comes to actually handing over their savings, only 30% would rely on AI for financial decisions.
So why the gap? Why trust the info but not trust it with the keys to the kingdom?
Because AI, for all its power, can't account for the core human emotions, the anxiety, the fear, the regret. When the market drops 20%, an AI model will correctly tell you to stick to the plan.
Logically, yes.
But it doesn't feel that pit in your stomach. It doesn't understand that you might sell everything at the worst possible time because you're scared.
So AI is brilliant at logic, but terrible at behavioral coaching.
That's it exactly. And what's fascinating here is that the advisor's role is shifting. It's less about being a stock picker and more about being a financial therapist. They bring emotional intelligence, they can hear your dreams, wanting to start a nonprofit in retirement and build a strategy around that human context.
An algorithm just sees a target number. An advisor sees a life.
And they read between the lines. A client mentions worrying about their aging parents.
The advisor hears long-term care costs and potential financial drain.
Yes, a critical non-market risk that an app would completely miss. It's about anticipating those soft liabilities that can derail a plan faster than any recession.
Okay, let's bring this back to local optimization. For someone listening in Stuart, the benefits of this human advice get magnified by geography, right?
They do. We know Florida has no state income tax, which is a massive advantage, but you have to actively use it.
So how does an advisor do that in a way an app can't?
It's all about timing. An advisor can coordinate big events like exercising those stock options or selling a big asset to maximize that zero tax benefit against the federal schedule. Things like proactive Roth conversions. That's basically a return on your investment right there, just from pure tax efficiency.
And the demographics of the Treasure Coast make this even more complex.
Absolutely. Stuart is a huge destination for retirees coming from high-tax states. New
Yeah.
York, New Jersey, Massachusetts. They don't just show up with a simple IRA. They arrive with incredibly complex estates.
Multiple retirement accounts, pensions.
Pensions, 401ks, real estate in 3 different states.
So they need someone who is basically coordinating the tax paperwork across multiple jurisdictions at the same time.
Precisely. It's a comprehensive strategy for distribution, for their legacy. An app just isn't built for that kind of multi-jurisdictional world.
Which brings us to the big objection, the cost. Why pay advisor fees when the app is free? We have to challenge that idea.
We have to. The idea that DIY is free ignores the hidden costs. The cost of what you don't do.
The cost of inaction.
Right. Missing the window for tax loss harvesting, not managing risk properly in a downturn, or the big one, failing to coordinate your estate plan. Those mistakes can dwarf any management fee.
Give me a concrete example of how that hidden cost could play out.
Think about insurance. An advisor acts like a financial quarterback, making sure you have the right liability and long-term care coverage. One single uncovered life event can wipe out a decade of investment gains overnight. That cost is infinitely higher than any fee.
So the real value isn't just in the returns, it's in the defense.
It's strategic prevention, sophisticated asset allocation, estate planning, and that crucial behavioral coaching. Just helping someone avoid panic selling in a correction is probably the single greatest value add an advisor provides.
So what does this all mean? The big takeaway here is not that apps are bad or advisors are good. It's that the future is hybrid. It's collaborative. You have to leverage technology for what it's good at: efficiency, access, low-cost execution, and you rely on human expertise for the rest: the strategy, the foresight, the context.
It really comes down to honest self-assessment for the investor. You have to ask yourself, are my financial needs really simple enough for just an app? Do I actually have the time, the tax knowledge, and frankly, the emotional discipline to handle it when things get complicated?
Those early retirement healthcare gaps,
Yeah.
the multi-state assets.
Exactly. If the answer to any of that is no, or even I'm not sure, then you've probably outgrown the purely DIY model.
So working with a professional isn't about giving up control.
No, it's about enhancing your insight. It's making sure your strategy is built for your whole life, not just for your brokerage account, which, this all raises an important question for you to think about. As this line between DIY and professional management keeps blurring, how will you make sure you're getting the best of both worlds? How do you get the efficiency of technology while securing the human wisdom you need to navigate the messy, complex reality of building wealth for the long term? Your decision today should be less about the tools you use and much more about the robust, personalized strategy that guides them.